Welcome everyone to today's webinar. We are going to get started and run through all about buying commercial property. We're going to look at what that looks like maybe inside a self-managed super fund, but also we'll have a look at stuff outside of super as well. In the chat box for me, if you could just pop in the state or even better, the town that you are zooming in from, just to get a little bit of an understanding of where you are based. What I might do is, for those who are brave enough, if we can keep cameras on, it makes me feel like this is more of a workshop than some, one-way seminar. Keeps things interactive. So, appreciate Andrew, Clara, Mark. Thanks for popping them on already. Renee, Nikki, Michael, awesome. Thank you. And the other thing as well, I'm going to be presenting a little bit differently. You can see the slides are sort of vertical there. So what would work best is if Zoom is full screen. Hopefully that's not too big for my head on your screen. That might be able to see those slides nice and clearly. And also, as I said, I prefer workshop style. So please have that chat box ready, and thank you for those who are already popping in where they're calling in from. Cool. So a bit of a variety of people. New South Wales, New South, awesome. Cool. All righty. Well, let's get stuck into it. Just as a brief introduction to Inspire, so we're an accounting firm based in Brisbane, but we work with small business owners all around Australia. So we've got clients from, most of them are in Brisbane, the majority, but we do work with clients Sydney, Melbourne, even over, we've got a few in Broome. We're getting a small group of clients over there, but also in Adelaide as well. So we're able to work with clients thanks to technology and it being the year 2024 quite easily. Love working with our small business owner clients. We also, in terms of what we focus on, one of those things is saving tax for our clients, where our tally is now sitting at over $36 million in tax saved. That was as of the end of June 2024, which was the end of our tax planning season. So really cool target to hit. And then in terms of a brief introduction to me personally, I started Inspire, the accounting firm, when I was 23 years old. I'm an award-winning chartered accountant. Apologies for that noise. Let me see if I can get rid of that. Cool. 17 years accounting experience and the author of 2 books, Wealth for Life and It's All Sorted. And there is a photo of my beautiful family without our 4th baby, who arrived a few months ago. A bit of a why I do what I do. In terms of the book, It's All Sorted. You can get a copy of that from our website. There's a QR code on screen or the link. Thank you, Tay. He's in the chat box. If you do want a copy of that, in terms of the relevant stuff in that book from what we're going to talk about today, it goes into a bit more detail on the structures we use, lending options, how SMSFs work, especially with property, and also a bit of a deeper dive into the case studies we're going to be talking about. And I guess, why are we talking about commercial property? Well, I said our small business owners are our client here at Inspire, and some of them, not all of them, but some of them rely on a physical premises to run, including us. We've got an office in the Valley. There's some that don't, though. And that's also dropped the supply of tenants in the market, especially over the last few years with the effect of COVID. And I feel like it's a bit of an opportunity for those who need or want their own commercial property to purchase. We have this conversation with clients quite often, not every single client, of course, but where they're looking to buy even their own premises that they're renting in, or something's coming up to market that they might know about that they want to secure and move into. The other note, I can see a couple of mortgage brokers on the call today, but I do want to flag that we are not mortgage brokers. I will be talking to observations that we see clients get in terms of like LVRs and certain things around lending. But if you do need finance for a commercial property purchase or any other purpose, it's not us you talk to for that. It is a good mortgage broker. And if you need a referral to a good one, just let us know. Alrighty. So the first thing we're going to have a look at is different structures that you can purchase a commercial property in. And I'll sort of even zoom out a little bit from a theoretical perspective and suggest that these are the four structures that are on the screen right now that you can basically, purchase property or invest in, or even run a business in certain conditions. So they're basically the four different types of structures available to you in Australia. Now, in terms of this first one here, your own name, the tax rate, that actually goes up to 47%. So do keep in mind that's the marginal tax rates. So the more income that a person earns, the higher their percentage tax rate will be. If we go over to a company, there's two different tax rates for companies, 25% being the small business tax rate, basically if that company runs a small business, or 30% being an investment only company. Now, there are certain conditions where we might be able to get an investment company under that 25% tax rate. But again, if we sort of go high level, there's 25% for small business, 30% for investment. Now, with trusts, we've got 0% there, but that's slightly misleading. Trusts ideally don't pay tax themselves, but they pay their profit to their beneficiaries, and then the beneficiaries pay the profit on their behalves, which are often people or other entities in the family group. And then the last one there is SMSFs. So there's two different tax rates at a high level with SMSFs, 15% being when the member of that SMSF is in accumulation mode, which is basically accumulating super throughout their lifetime. And then 0% is when the person is in pension mode, is what we call it. Now, that's when they're drawing on their super balance over time once they've hit certain conditions to access their super. Now, there are lots of different scenarios where people will pay different rates, but again, I'm just trying to keep it high level, not to go super detailed. Now, the next thing we want to consider when we're looking at investments through these entities is access to the 50% CGT discount. Now, the first one here, in your own name, you do get a 50% discount if you hold an asset for more than 12 months. And that would, if we're looking at commercial property, for example, that would definitely include that. And we're looking at contract date to contract date. Often people get confused with settlement dates and contract date, but from CGT purposes, for the 12-month rule, we're looking at contract date for the purchase to the contract date of the sale. If we go to companies do not or aren't eligible for the 50% CGT discount. I'll sort of wrap up on that last line of why that's not necessarily a deal breaker. Then we go to trusts. They can get access to the 50% CGT discount, but they have to distribute that capital gain, that discounted capital gain, to an individual to basically maintain that 50% discount. If the distribution is to a company, you revert back to grossing up that gain. And then in an SMSF, we do get a CGT discount for holding it for over 12 months. But instead of being 50%, it is 33%, or basically it takes the 15% tax rate down to a 10% discounted capital gains tax rate. And then in terms of what we use or what we would recommend, the first one there is we would not recommend buying a commercial property in your own name for a few reasons. One of them is inability to manage tax. The next one is often they really suck for asset protection purposes. If you buy it in your own name, you run a business, and for whatever reason, your personal assets are exposed, then the asset of the commercial property may be at risk. So yeah, we don't recommend it. We do have clients that have commercial property in sole traders, but that will be sins of the past or other advisors not being on the ball, and just not being a great idea to go and move that company, the commercial property into another structure. But sometimes it is. All right, now the next one here is, do we use companies for commercial property purchases? I'll say occasionally or sometimes. It's a bit of a rare one. Now, usually this would apply to higher income family groups where they're earning sort of 400-500K or more annually in profit a year. And why we look to purchase in a company and forego that capital gains tax discount is because often a family group of that sort of income level may be dealing with other issues such as Division 7A, which is to do with lending money out of companies. Now, that is a webinar for another time. We do have recordings if you are dealing with the dramas of Division 7A. Please let me know if you do want access to that. But again, at a high level, sometimes we use companies. But if we're looking to purchase outside of super, most of the time it will be in a trust, whether it's discretionary trust or unit trust, would be dependent on the circumstances there. And another one that our clients regularly use is their self-managed super funds as well. Yeah, I'll sort of break down the pros and cons over the next little while of those two options. So yeah, if we go high level again, we've got outside of super, it's probably going to be a trust. Inside of super, well, self-managed super, and occasionally outside of super will be purchased in a company. Alrighty. PS, there's a few people who joined after I started. If you do have questions, then pop them in the chat box as we go. I will have a Q&A session at the end. Yeah, if I don't answer it throughout the webinar, I'll go through right at the end. Now, in terms of lending options outside of super, I'm going to say normal lending because the self-managed super fund lending is just a little bit weird. Weird as in it's still fine, but it's got a weird name and heaps of rules around it. If you're going to buy it outside of super, you're going to have a higher tax outcome just because the rates are higher outside of super. Now, in terms of a lending perspective or what the banks we've observed they will consider is usually your business or personal income to service that property. There's certain banks that apparently can look at the existing rent expense in your business. And if you're going to own or occupy that new purchase, they might consider that rental expense as their ability to service as well. And then the other thing is, and these are sort of like differences. So the serviceability is different with SMSFs or outside of super, and so is this security thing. So outside of super, let's say you've got equity in another property. Often the mortgage brokers can find a bank that might be able to use the equity in another property to use as a deposit for a commercial property purchase. That is not the case with SMSF, or inside super. So inside of super, we've got this thing called the LRBA. It's an acronym that's for Limited Recourse Borrowing Arrangement. Basically, it's a whole heap of paperwork to get around the fact that on their own, self-managed super funds cannot borrow money. They use this arrangement, this thing called a bare trust, to borrow the money from the bank for the SMSF. So again, it sounds complex, although at the end of the day, there's lenders who fund commercial properties under this structure all the time. So it's not like it's abnormal or too weird. Now, in terms of serviceability, again, our observations from clients going for this stuff is that the banks may consider superannuation contributions that the family has made to super. And that doesn't necessarily mean into the SMSF. It could be at other super accounts that the family has had in the past, and they may look at those contributions to consider servicing. And then obviously the rental income that property might generate for servicing in that SMSF as well. Now, I mentioned this one earlier, but tax at 15% or 0% if the member is in pension mode, meaning those conditions of that Cayman Islands tax rate. And then if we look at, again, because of the special type of lending, there just isn't the amount of lenders who will lend under this style, but there is still, there's sort of brokers use some go-to lenders in this space that basically just do this day in, day out. So it's been easy for our clients to get funding for these things. Typically a slightly higher interest rate than you'd pay out compared to outside of super. And then the other thing is, this is totally lender dependent, but we've seen the client be asked to get legal advice and financial planning advice, basically for the banks to push risk onto the client and their advisors. So that may be an outcome if you're looking to borrow money inside a super. Because we're lending, that there needs to be a bit of cash in the SMSF to go and fund the purchase, fund the deposit of the SMSF. And I'll sort of compare that to outside of super, where you can access equity in other properties. You can't do that in super. In fact, I haven't heard of a client who's been able to use equity in one property in super for the purchase of another property in super. They essentially have to be sort of separate things and kept separately, and you can't cross-collateralize, at least that I've heard of, and that I understand the how the superannuation rules work. So yeah, that is a big difference. A bit of a mistake I see, or inadvertent thing that happens with clients, is they focus on paying down the loan on their first property in super with the intention to go and buy another property in super. But what they can't do is redraw off that loan. So yeah, just need to be careful with your overall strategy. If it's to buy multiple properties into super, just again talk with the broker about the best way to go about dealing with the initial loan and then timing of that second property purchase. Last one here, you cannot borrow for construction costs unless it's off the plan. So basically, in super, due to the borrowing rules and all the complications around this, you cannot, let's say, pay cash for a block of land and then use finance to pay the construction portion of that. But you can buy a house and land package from a developer. So go figure, just one of those quirky SMSF things. Yeah, I think the property developers have been onto this for a little while now. You can even buy off the plan commercial properties. We've had a client do that recently in one of those sort of commercial precincty things where it's going to take another 18 months to finish the build. But because you don't go for the loan throughout the construction period, when the property developer finishes the build, that's when you have settlement, when the loan starts, and you're buying. Basically, the rule is about acquiring a single asset. So you've got one contract that settles when it's complete. So yeah, that is one other thing to consider. Now, in terms of what are we talking about here? Owner occupying commercial property. You can do that inside of super. So you can buy a commercial property for your own business and rent from a related party. And we have seen LVRs, loan to value ratios, go to 80% as well. I haven't seen any more than that, but definitely see them go to 80%. Deposit required. Yeah, again, another logistical thing if you're buying in super, that it actually, yeah, depends on the lender. A few things. And again, this has all been feedback from what we've seen. We've seen different postcodes attract different LVRs, asset types, price points. But yeah, generally, what we see is that the client will need 20 to 30% of the value of the property in cash plus stamp duty. And then sometimes that lender will also require a 10% of the value of the property in liquid cash. I haven't seen that recently though. So it's been a long time since I've seen that requirement. And so if you're considering buying a property and you understand what your SMSF balance is, sometimes clients may need to contribute more from outside of super, some cash into their SMSF to be able to make up this deposit and minimum requirements. So, and then that also has considerations because you do have limits on how much you can get into super as well. All righty. Cool. Now, in terms of the buying process, we often, if clients are exploring this, we send them to the mortgage broker as stop number one for pre-approval. And also we work in tandem with the client and the broker usually around, what's the best entity to purchase this in? Are we looking at SMSF and what's the requirements going to be of that? But pre-approval, even if you are going to buy in SMSFs, brokers can do without a self-managed super setup. So do keep that in mind, that it's not something you necessarily need to spend the money on first, roll it all over your existing super into an SMSF to then go and get pre-approval. You can do it without having all of that and the associated expense. Next step is if you're going to get it in super, you set the SMSF up and the thing called the Bear Trust, which will actually be the name if you're funding it. The Bear Trust is actually the owner of the property, not the SMSF in its own name. And then what I usually recommend to clients is you want about a month to 2 months to be safe in terms of lead time as well, because sometimes depending on where your existing super is, it may take weeks or months if you've got a pain in the ring super provider for them to action the paperwork to roll over your existing super into an SMSF. A lot more simpler, straightforward, and instantaneously in a company or a trust. They take pretty quick in terms of like 24 hours, we're ready to go with that stuff. So it's a shorter lead time if you're purchasing outside of super and need an entity set up for that. And yeah, the big difference is you don't have a third party you're waiting on money to roll over from. And then, the next step obviously is to find a property, make an offer subject to certain conditions. And that's where your lawyer is your best friend at this stage. Get a good commercial lawyer who's dealt with commercial property purchases. There's typical clauses or conditions we see is finance, of course, due diligence, and making sure that property is right for the buyer. And then all around the same point, especially if you've got pre-approval, this step is easier. But then you just need to apply for that finance. And if accepted, proceed to settlement. And then that property is yours. Cool. And then just wrapping up on the SMSF side of things, just explain that LRBA in a bit more detail. I usually go through this sort of diagram. So an SMSF cannot borrow to buy a property in its own right. It's got to have this Bear Trust. It's basically its own trust with its own trustee company that acts as the buyer and is basically this shadow entity in the middle. A Bear Trust can borrow money from a bank, i.e. a third party, but you can also lend to a Bear Trust from your own entity outside of super. So we have sometimes clients self-fund this with, let's say, money in their bucket company or corporate beneficiary. They've got a bit of cash there. They want to deploy it in a smart way. They go and lend their SMSF money for the purchase of a property. So that is another outcome as well. Alrighty. And then purchasing a commercial property in an SMSF can be done other ways. So you can buy it outright with no loan, and there's no Bear Trust required because there's no lending on that one. Another way to do it is buying it outright with no loan, where you've got a percent of ownership inside super and a percent of ownership outside of super. That one has to be purchased through a specific type of trust that allows no lending or no mortgage on that property. So again, a little bit of a complex one, that middle one there, but it is possible to use, let's say you've got 200 grand in super, 100 grand outside, and you don't want a bank involved. We can make that happen with the right structure. And then we've got this other structure with us called a SUIT or a superannuation unrelated investment trust. Now, what we use this one for is where we've got multiple business partners, basically one family group who owns the property indirectly through, but doesn't want to own more than 50% of the property. We can use this type of trust to purchase where, let's say we want to buy $1 million property. We've got two family groups. They've each got 200 grand as a deposit. We've got 400K. So we go and lend the difference, but we do this in what's called a SUIT. So yeah, occasionally we get this structure out of the toolbox and apply it if the conditions are right there. Cool. Now another one here, we've got case study number 1, the vet from the bush. So this is a client where they had a commercial property in their own name. It's one of the ones we would not recommend. And the client wanted to, so they had a loan that was expiring, a sort of short term, maybe like a 5-year finance thing from the bank. It was expiring soon, about 150K left on that loan. We looked to move that property into an SMSF. And basically he had about 150 grand in super. He was able to pay out. So if you think in the books of the super, you're buying the property, and you've got to buy it off the person or the individual selling it. So he had to basically, he used the 150K or so in super to pay out the debt. And then the SMSF still owed about 150 grand in cash for the purchase of that. So we did that on a vendor finance arrangement, where his own SMSF still owed him 150 grand. Now, in terms of what's the long-term way we pay that off, or the super fund pays it off, we basically use his own superannuation contributions and rent that his business pays to his SMSF to pay down that 150 grand that he's owed. So literally, let's say it's 20 grand of rent plus $30,000 in super contributions. So 50 grand goes into the SMSF, and there goes 50 grand back out as a loan repayment. So it's pretty cool when, and where this one's handy is if clients own a commercial property outside of super, but they're looking to get it into super. Maybe it's for retirement. They want to move assets in there, long-term, better for tax environment. And they've got a bit of equity. We can use this sort of contribution strategy to get paid back on that vendor finance arrangement. So again, a little bit of a complex one, but fantastic in the right circumstances. Another client we've got who they had a commercial property owned outside of super, had about $1 million in value. They're wanting to shift assets into super, moving into retirement. And what they did is basically move the property in there. They had about 300 grand in super. So it's a big difference between 300K and $1 million. They found someone to fund it. Basically within 2 to 3 years of that sale into super, they received an offer to buy the property for 1.3 million. Because the client was retired, they basically, and were in pension mode, they paid no tax on that $300,000 gain, compared to probably 30% or more outside of super. So pretty cool outcome. Another one is an IT business in Melbourne. So this is a client who was renting a small office in Melbourne, but grew substantially through the COVID period. The owner had an opportunity to buy basically in one of those commercial warehousey sort of things. The purchase price was around 300 grand, so not super expensive. And the property needed a fit out, which was funded through prepaid rent. And this purchase was done in super as well. So the fittings and furniture were paid for by the business itself because they were able to access the instant asset write-off. And then the client is now paying a similar rent to what they were, but it's to his own SMSF, building his own wealth in super. Another case study. So this client had a home office, again, another construction-related business who was growing through COVID. They had a baby on the way, and we're getting a bit sick and tired of team coming to the house and working in almost a granny flat out the back. So this client found a commercial property that's a few minutes away from his house. Secured it for 800 grand with his SMSF, with a 75% LVR on that. He did renovations on it. Again, if we swing back to an earlier slide, you can't fund construction or renovations with funding. It's got to be paid cash. So do keep that in mind. So this client did the reno with cash in his fund. Furniture for the office was paid for by the business, getting the instant asset write-off. The client's got a lovely shop front, and this it's actually sort of like an old house that's been made into commercial property. He's got 2 tenancies, one for his own business, and he's got another tenancy right beside it as well. So second income from a different business. And then our fifth and final case study. So we had 4 business partners buying a property, and they're basically an office space. They all had SMSFs, and they all had at least 200 grand or so in cash that was able to be used towards this purchase. So we basically set up a trust specifically to own the property, and then each of the SMSFs purchased a percentage of that trust, and owned, the SMSF owned units in a unit trust essentially to make this one happen. The property was worth about 750K plus stamp, and 0 lending on this one because of the cash payment. Cool. I can just ran through that. But yeah, basically an ungeared unit trust, no borrowing. Each business partner owned 25% through units, and the trust owns it outright. Cool. So there's basically a heap of ways we can pull this stuff off. And the best, we sort of talk with our clients to work out what they want to achieve. There may be multiple ways to achieve the same thing. If we look at where's the money coming from, what's the long-term strategy, what does it look like? So some clients are maxed out with their personal borrowing capacity. So the mortgage broker says, well, we actually can't buy it outside of super. Let's have a look at inside of super, because generally the banks don't need to consider outside of super servicing to make that happen. So yeah, it's sort of every situation is quite different, unique, it's coming up with the best plan possible for our clients. We will switch into Q&A shortly, but if you do want to talk more with one of our accounting team on this stuff, then please book in an initial chat with one of our accountants. You can do that with the QR code, or Tay has just posted a link to our page on the website where you can book that one in. I don't have a Q&A slide, but here we go. Let's go to some questions, and hopefully I can give an answer. So feel free to use the chat box. I don't think we've got we haven't got a Q&A specific box. Steve, hello. All righty. Come on, Steve, at least you've got a perler for me. All righty. Any questions, any scenarios we want to run through? Oh, well. Oh, Andrew, you got one? I think Andrew may be typing a question. And feel free, if you do want to ask one, just take yourself off mute, and that might be a bit easier.
Can I throw a question at you, Ben?
Yes.
Damien is here. Is there a material difference between SMSF purchasing in commercial as against residential?
Yes. Yeah. Like even from a broking perspective, it's under 2 different codes. So, and I know this because I was a mortgage broker for a couple of years, and then I gave the ticket away. But residential is under NCCP. It's basically a heap more rules. Commercial is under a different set of legislation, so it is materially different. Yeah.
So it's really just ROI. If you're, I'm interested in. I mean, I've got properties in my own name.
Yep.
But I'm interested in doing it through the SMSF, and I'm just trying to work out, because I've not looked at commercial property at all. And I'm just looking up return on investment. My background is residential development and construction.
Yes.
I'm more comfortable in that sphere than I am in the commercial zone.
Yeah, well, again, an SMSF can purchase residential property. You just got to consider that off the plan purchase if you're looking at house and land. And yeah, the LRBA, that sort of lending arrangement applies to residential in SMSF as it does commercial. So it's similar.
Can you put a capital improvement on a purchase that you've already made in SMSF pre-pension mode? Let's say, for example, I purchase a large parcel of land. It's got a single dwelling house on it. and there's room for a second dwelling in the backyard. I think in New South Wales we call it dual occupancy. I don't know what you call it in Queensland.
Yep. Get the idea. Yep.
You can't invest in that, can you? Because it's sort of subverting the very purpose for which I'm just looking at the implications of bringing capital investment into, because it's increasing the value of the super
Yeah.
fund artificially, perhaps. It's not going through the vehicle where you're contributing cash to a fund, you're paying the 15% going in.
Mm.
Doing a capital investment, like as a secondary dwelling or something on the same parcel of land, you've got that taxation implication also.
Yeah, that would have to be in the fund itself, given that's who owns the land. And then I think there may be a rule or two around doing that with funding. So that's probably a scenario best dealt with offline, I reckon.
Yeah, sure. And you can look after residential through SMS.
Yeah, absolutely. Yep.
Good man.
So
Thank
you just can't own or occupy, which is fair enough.
I understand that.
Yeah, yep. So
Having trouble convincing my wife of that aspect, but that's another story.
yeah, I wouldn't nudge that one. That's
Well,
yeah.
she's interested in, for example, a B&B. She's a top-notch chef. She's thinking about doing something like that, and it's balancing that, how she would manage that, how I would manage that.
Yeah, yep. And the other one we've seen is having different titles. So if you've got properties near each other, B&B wise, and there's an ability to have two different titles, the commercial aspect of it's in the SMSF, and maybe there's a family home that's cut out separately. That could explore that one.
Okay.
That way you're not cutting it fine or walking that.
Sailing too close to that breeze, as they say.
That's the one.
Thank you.
Cool. No worries. Andrew, did you have a question?
Yeah, I was just wondered what you might call a situation where you purchased into a property trust. So, there's a commercial building and there's, I don't know, maybe 10 owners or part of that group property trust.
Yeah.
Would that be something special, different again from what you've just discussed?
Yeah, so the LRBA is sort of where the SMSF directly holds, but there was a couple of case studies there where they invested into a trust and then the trust purchased that investment. So yeah, that's absolutely possible. And again, this is where it's great, where we've got the client, a great commercial broker, and us in the room, particularly around development, because where you've got multiple business partners, we can set up a certain type of trust that in its own right can lend without all the LRBA crap. I say crap, there's just limitations to it. Great where you're on your own, but where you've got multiple business partners, it can be fantastic. And we've seen I had a client a few years ago. They were looking at about a $2 to $3 million development. There was 4 business partners. They had experience with development, and we basically worked out with us, them, and the broker that they could start looking for stuff around the $10 million mark for developments. And that was the stuff they were actually experienced with. 2 to 3 million was a lot smaller than what they dealt with at work in their day job. So yeah, we opened their eyes to the capacity there. Again, the right structure is key for that.
Yeah. Okay. Yeah, because it's an existing commercial property that has, I think, and we've become aware that one of the members wants to leave, obviously sell their share out. At the same time, there's tenancies in there that we could actually use as well. And I don't know what the size of the share is compared to the value of the tenancy. I don't think it really matters at this point, but ultimately the idea would be that we would take some of that space at some point.
Yeah.
And I guess finding that balance is the question mark.
And I think from a investment perspective, or they would be seen as two different things. So if you're going to use super, your SMSF would buy the share off that exiting partner, and then your business would then have the lease completely separate with the SMSF. So
yes, okay.
Yeah, but I mean, yeah, because they're unrelated. That's just two relatively straightforward transactions.
Yep. Okay. Good.
Cool. All righty. So I have a question in the chat box. So if I don't have enough in super to buy a commercial property, you can combine my SMSF borrowing capacity and then via an asset. Oh, Steve. So they would buy shares in a unit trust, the SMSF and the privately held. Okay. I think there might be a couple of strategies combining there, Steve. So we've got more than one family group who are looking to purchase something. That's when we usually have SMSFs investing in trusts, and the trust then owns the asset and can access potentially different style of lending. You've also mentioned your holding company outside of super. This is more so with a single family group, and you've got cash outside of super, a bit in super. You can lend it to your own SMSF. So that's possible. But yeah, I think you sort of combine those two, which makes my brain malfunction at least right now. There may be a way to pull that sort of thing off, but and even if I flick back to the property development example when I was talking with Andrew just then, that I do distinctly remember some of them used money from their SMSF and equity they were able to draw down on outside of super to use towards the investment as well. So yeah, there's heaps of ways this stuff can happen. Yeah, again, I can't recommend enough the power of the accountant from a structuring perspective, commercial broker from what banks will do what, and then the client telling us their dreams, and our goal is to make that happen. Alrighty, so Clara's asked, what's the best setup if we want to purchase commercial property with our SMSF, but there are other party would like to purchase together with us. So again, I probably wouldn't explore the LRBA option because LRBA is usually for one family group, but that would be some of the other trusts and the sort of special trusts that we set up depending on the circumstances. So yeah, it's hard to sort of give an answer there, Clara, without understanding exactly. Alrighty, Natasha. Hey, there's a couple of people joining with my surname. There you go. Don't recognise relations though. Is it better if I purchase a commercial and put it in a trust? I'll be running my business out of this and living at the top. Yeah. So there's the deal breaker for SMSF, including living at the top of it. So, yep, I also own another house. Can't I see this? How do I save myself rent? Yeah, Natasha, I don't quite understand the question towards the end there. But yeah, if let's say you had a trust that purchased this commercial plus residential property, you personally could pay your own trust to market rate of rent for that bit at the top, and then your business could pay your trust to market rate of rent. Yeah, you just literally have a rental agreement between the investment trust and you for the resi side and your own business for the commercial. A mistake I see clients do is they want a property for their business and they buy it in the business. Seen that a couple of times. That is an asset protection mistake. We don't want clients buying commercial property in the name of the same entity that runs their business. So yeah, very important, that one there. Yeah, hope that covered those aspects. All righty. Well, that's,
Tristram here. I've got a question for you.
Yes, Tristram. Yep.
So just wanted to know if my partner has money in a self-managed super fund. I currently don't have one, but I'm looking at converting to an SMSF.
Yes.
Would we be able to combine forces easily enough to buy a commercial property?
Well, so an SMSF can have up to 6 members, which means that if your partner already has an SMSF, you could become a member of her SMSF and then essentially be in the same one. And then from a borrowing perspective, again, pending chat with broker, they'd look at your balances and your contributions in total.
Something keeping the SMSF, separate for the longer term, but just sort of combine forces to buy a property together rather than sort of throw our all in with combining finances. Is that viable at all? Or is that complicated?
Sorry, it's just a touch hard to hear. Are you able to repeat the question? I missed the early part.
Yeah, sorry. So what I'm saying is we probably want to keep our SMSF separate for the long term, or certainly for the foreseeable future, but we're looking to buy a property together and just looking at ways we can do that without necessarily combining our finances.
I see. Yep. Okay. So separate SMSFs, buying a single property. Because I'm guessing you'd be classed as spouses. You'd be seen. The SMSFs would be seen as related parties. The thing that comes to mind is there's a type of trust, but it's an ungeared trust. So I'd say that it's a potential outcome, but I just don't know that you can have you can't have lending in that type of trust. That's on my mind. I just have to think about if there's another way to make it happen if you did want funding. Cool. Hope that helped.
In a separate conversation then.
Yeah. Yeah, too easy. Awesome.
Okay.
All righty. And I think that might be about all the questions. Oh. And yes, it is recorded, Natasha. So we will be sending out a recording to people who are registered a bit later. And thank you, Steve, for the message there. All righty. Well, I think that's about it for today. Thanks, everyone, for joining. Hope that was helpful with whatever you're looking to do in the commercial property, SMSF, all that sort of space. Again, if you want to have a conversation about what you want to do, just even reply to the email where the recording comes out, and reply back to me. That is totally okay too. But yeah, all the best with your investments and everything that you're doing. All right. Thank you very much.